Hey everyone, welcome to another edition of the Buddy Study Group for Worksite Solutions. And today we're going to do a little product roundup for Q1 2025. So when we do product roundups, it can really be a wide-ranging discussion. Obviously, the four carriers we're working with most commonly, but it's probably good to talk through what we've learned recently, what we've kind of picked up from our conversations with our carriers we're closest with, and what we're kind of hearing, among the tea leaves with new carriers, new options, maybe new products from familiar carriers that are going to be entering the market. So feel free to ask questions as we kind of go throughout this, and we're happy to answer them. But yeah, just kind of wanted to give you a high level overview of what we're seeing lately and what we see coming. Mark, do you have anything you want to start with that's on your mind?
The only thing is we're going to talk about it for Q1 2026 because now we're in 2026, but I
I
won't give you too hard a time
even
about
I even
that.
put that originally in the agenda email and was corrected then. So I'm just living in the past all day today. Um, so Mark, one of the things I wanted to talk about because it's new but not new, and I think we're starting to pay a lot of attention to it, um, which is the standards term to 100 product. There's a number of reasons I think it's worth paying attention to. Number one, if you like the standard whole life product and um, like the way it works from a premium guarantee standpoint, but maybe you're looking for something a little bit more cost effective, I think it's a great alternative. But I think we are also starting to see a lot around the 5% inflation on the monthly long-term care amount. And we are starting to warm up to it quite a bit. And it has quite a bit more availability than we originally thought. So that'd be a good one for us to at least start with. And I guess what I can do is share my screen and do a comparison of at least the base term life plan to the group whole life.
Yeah, and let me pontificate real quick just to add to what you said. The most popular product in the group market, from what we see, is actually the term life with the long-term care.
Yep.
Um, and it's not a term that expires, so they call it permanent term, right? Allstate or standard, I should say, has term to 100. Trustmark, Chubb, and a couple other new carriers have a term to 121. So those are really hitting the mark, I think, for a couple of different reasons. One, obviously, is cost, right? But another is perception. Clients like the idea of being able to get their long-term care benefits on a term style policy. You can't even get that really in the individual market. So it's a new idea. And therefore, anything new, people want to take a look at and pay attention to it. So I do like leading with it. I also kind of mentioned that, with employer groups, a lot of the story is about getting somebody a starter plan, getting employers to want to pay for the plan. And what employers care about is what's the budget on this going to be. So it is a cost to get your foot in the door, but it doesn't mean that you can't still buy up to significantly higher amounts of coverage. So I'd say don't get caught up, too much, on the benefit levels as much as, understanding the purpose of getting that plan in place. And in particular, we've seen a real lot of case studies recently because Unum discontinued their legacy traditional policy for new hires, which was obviously purchased by employers at low funding amounts, right, and even low benefit amounts. And this is actually very competitive to that, these term products. So for a lot of different reasons, it's all kind of meeting the mark with what clients need, and therefore becoming very popular in the market.
I think it's familiarity too. If there's any life insurance benefit that most employees are going to be familiar with purchasing through their employer, it's term insurance. This is a different type of term insurance, like you said. but many employees are interested or at least introduced to or familiar to through their employer a period certain term, like a 10, 15, 20, 30 year term. So I think it's a favorable spin on an old classic for many, which makes it a little bit easier to understand. You know, there's no real mention of cash value, anything like that, that needs to be gone through, like what may have to be done in a universal life or a whole life discussion, even though these products try to run them relatively close to zero. It's still something that gets asked about and questioned quite a bit. So I think it is definitely something that we're seeing grow in popularity with the standards offering in particular. And you can kind of get an idea of why. Now, there's reasons to love both products, right? It's just the fact that I think the cost effective nature of the term product is really turning heads. But many groups will still really appreciate the whole life story, guaranteed premiums and benefits through age 121. Knowing that what you see is what you get immediately out of the box and forever is really nice. There are people out there who are whole life heads as well and just want to be able to offer that as a benefit. But you can see you do pay a significant amount more for the whole life compared to the term to 100. So some groups just may find that there's greater financial latitude for employer funding by using the term to 100 plan. Now, obviously, there's a discussion to be had there that it is term to 100. So if we are planning to live beyond 100, as probably a low percentage of people will end up living past 100, but it's still a conversation to be had, right? But many are able to not see that as much of a sacrifice when per 45-year-old employee, you're able to save about 18 bucks a month. That's very, very significant in this case with the same extension rider, with the same restoration of death benefit rider.
Yeah.
Jason,
Um,
can I ask a question?
yeah.
This
Yeah,
is
go
a
ahead.
true long-term care, not critical illness, chronic illness, right?
So the contract language is going to be you know, identical to 7702B long-term care. It's just not filed as 7702B long-term
Okay,
care. Two out of
The
six ADLs or severe cognitive impairment.
the whole life is that way. The term life is 7702B though.
so it's
That's
critical
correct.
chronic illness, but it goes by the rules of the long-term care policy.
Yes.
Correct.
Mhm.
Thank you so much.
Yep, no problem. Um, One of the other things is that we're really starting to warm up to is that 5% inflation protection on the monthly benefit. I believe that is still, yeah, this is in here, and you can see still very cost effective to be able to add that. That's $3 a month to be able to add that rider. Now it's not the typical 5% compound inflation protection that we're used to on other hybrids or traditional long-term care or even the group whole life in California and Utah, where your total long-term care benefit increases with that monthly acceleration amount. Think of it as you get the same size glass with relation to your total benefits, but your straw to sip that drink out of gets larger and larger, right? So you get access to more of your long-term care benefit per month without raising the total amount of long-term care. I mean, again, Mark, cost is why we're seeing, um, a lot of interest in this plan, even from us internally. But what else? What else do you have to add there about the 5% that draws your eye to it?
I just think it compares well against what people have learned about, traditional policies, about the importance of inflation and the cost of care rising. And if you can get, and you can project it out, even further or with higher amounts of coverage, you're going to put a significant dent, right, on what the full cost of care is going to be. We're seeing the popular in the individual side of short-term care, for example, a one-year
Yep.
benefit. It's not about necessarily the duration of coverage, that's the motivating factor. It's about getting something that's covering a chunk of the risk. And that
Right.
first year chunk of the risk is really important, to almost everybody that we talk to. So, that story, that conversation is playing really well, and it doesn't make people feel like they're getting too little to make much out of.
I need to be on claim for X amount of years or I'm not going to fully realize my coverage, right?
Exactly.
Shorter claims, which there are plenty of, definitely benefit immensely from having this.
I presented this to a client this morning, and we showed them, this is a 33-month plan, and it will shorten the benefit the more you get. But we talked about, well, if you get more for your monthly amount, you can always put that money into the bank and use it yourself to extend out your benefit period, right? It's not a bad thing to get more money from the insurance
Or for
company.
things like, that are important and generally happening in the beginning of claims in the home, right? Home modifications, certain durable medical equipment that may be needed. Those are big things. If we're looking to age in place, we have to make sure, you know, wherever it is we plan to do that is set up to properly accommodate us, right? And accommodate just our everyday living.
Yeah,
If we happen to be in a wheelchair or have problems climbing stairs, whatever it may be, getting through doorways.
yeah.
At the end of the day, that's a helpful piece too.
And Lynn, feel free to type in your questions. I know they're private messaging, but yeah, feel free to go in the chat. They are all really good questions. But yeah, indemnity benefits here. So just a lot of flexibility in how you can combine it with different other
Right.
plans that you might have already.
Oh yeah, because most chronic aren't that way. And let me ask you a question. What's the minimum on this product? Or well, we don't know. Each carrier is going to be different coming out with this plan, but for this standard, how much? What's the minimum amount of people?
Yeah, we usually recommend the 10,000 that Jason's showing. Remember, it's only
Ten
$600 a month
thousand
to
people?
start.
No, no, no. I mean amount of people taking it. Like,
Oh, sorry. Participation minimum
yeah.
with
Sorry.
this plan is six.
Six applications, three lives is the lowest they'll go down to for guaranteed issue. So you will need to add another voluntary benefit product if you're under that six lives
Right.
and reach that six app minimum that way.
On these benefits, can you add your spouse?
You can.
Or you can.
Correct. Yep.
Okay. Thank you.
Spouses generally have a small amount of guaranteed issue coverage.
Thank you.
Yep.
Yeah. Well, the reason this level is important too on the 10,000, it's not something like we would say is a comprehensive policy, of course. But if you want to hit that minimum, or if you want to get employer funding, these are good ways to use that lower level of coverage because that's your entry into the guaranteed issue. That's your ability to offer buy-ups, to buy more comprehensive coverage. So you don't necessarily have to recommend this as the plan that you would recommend people purchase, but you do get a lot of value out of this level to get access to the product in the first place.
Yep.
And again, these monthly premium amounts you can see are not going to break the bank for most companies, even on a funded basis. So we see a lot of companies that are willing to pay for a 10,000 benefit for all their employees. And you shouldn't be shy about asking for that. Of course, you can carve it out and do it for certain employees, but the all voluntary plans, as we've talked a lot about in the past, are the ones that are much more challenging to enroll, where you're going to get lower participation. It seems always like, oh, there should be a ton of people that want this, product, but just given the time frame you have to enroll it and the education required, and just people are really busy and busy at work, they're not paying attention to it enough. They don't enroll. So it really is important to leverage that employer funding and just keep in mind your voluntary participation is going to skyrocket if you can get that sale made. So everything works well. Any employer funded case, in my view, is a good case. Anything that's not, you have to be really pushed back on. Otherwise, you won't have good outcomes.
Yeah, it's sorry, but it does take more convincing when you have to do when it's voluntary, you know.
Of course, yeah.
But adding the term, I think, actually makes it more, it's not like you said, a substantial policy, maybe enough coverage, but that the term, people always go to buy term because they figure it's cheap, blah, blah, blah,
Mhm.
and then, oh, I got another benefit. But can you, if you had 10 people, say employees, can each one have a different amount or they have to all stay the same?
Usually we try to do the employer funding at the same amount, just
Right.
easier to enroll, but they don't have to. Some of the
Okay.
carriers will let you do like a target purchase premium, a target premium approach.
Like a
Um,
25,000 minimum or 50, whatever.
yeah, that's like a target benefit approach, which is the
Yeah.
most common. But yes, you have some flexibility, but we would always say keep it simple because it'll be easier for you to enroll if you just set a benefit amount for the
Right.
entire class of people.
Yeah, if you're gonna
Right.
do like a PEPM, like per employee per month sort of premium target, you
Yeah.
can run into issues with groups that have maybe some older employees
Oh,
not
yeah.
hitting the minimum on a certain amount of contribution. So it's just something to watch out for. It's always kind of a case by case determination, and you always just want to lean on your carrier rep to say what is possible, what might cause a strain, etc.
Right. Is it possible for, if it's not all, if the, sorry, if the owner doesn't want to contribute, it's going to be a voluntary. But if the owner wanted to contribute, say a minimum plan, can it be voluntary to build on top of that, or
Correct.
is it too complicated?
Yep, it can be a base plus buy up, which is what we
Okay.
generally call that strategy.
Yeah, that's a
All
great
right.
question. I mean, it does add another dimension to it, but we always want to encourage buy-ups. So we built our platform to accommodate the flexibility to do that and to add
Great.
spouses like you asked about earlier.
All right. Thanks.
So Diane has a really good question here, Mark. On a
Mhm.
on a term to 100 plan, how is a claim generally handled when open, say at age 99 or right on sort of the edge
Yeah,
of
usually
that?
they'll start paying the claim and they won't terminate the claim at age 100. They just won't start a claim beyond age
Correct.
100.
Yep. Yep. And Trustmark has a similar sort of setup with their universal life events plan, where the policy actually matures on that plan at age 100. And it's the same deal. If you have an active long-term care claim in the works, that will be honored, through the duration of the claim. Of course, death benefit would not be paid out after age 100 for the term plan, but an active long-term care claim, they're not going to disrupt or turn off, but no new claims after that period certain. Good question. Um,
So just to kind of recap, there's a class of products here that are designed to be low cost, you know, policies, right? Entry level policies, that's the term. But you can also use universal life and like the Transamerica products, even with its minimum funded, and you're going to see that the pricing is going to be competitive to the term pricing. So I think that's kind of it's interesting. You have the term life, you have the universal life, and you have the whole life, right? Which is kind of at the high end. But the universal life, you have a choice of whether you want to price it like a term or whether you want to price it like a whole life. So
right.
it kind of is a little bit more like a Swiss Army knife. And that's why we
And
recommend that product. They also go down to 5 lives with Transamerica. So it does accommodate those small groups. So you do have good product availability in that small group market in most states.
yeah, that's a good point, Mark, because I mean, this is the difference for those of you who are in here between high cash value and high face amount. I think that's a great way to put it. Do you want to price it a little bit more like a term plan or like a whole life plan? But can you just go a little bit more into kind of the differences here um, between high cash value and high face amount? You can see the pricing is about a $15 a month difference for this 45-year-old example at a 50,000 death benefit. But this is
Basically,
about the duration that this is expected to last,
mhm,
from out of the box, right?
right. One's priced to age 80. So it's like universal life price to age 80. That's the minimum cash value accumulation. And then the other one is the price to age 100 or higher, I'll say, where, it's expected to be more of that permanent funding. So they're less likely to have to increase their premiums later on in life or risk lapsing the policy. remember the client will always have the ability to pay the higher premium because it's a flexible premium
Right.
universal life, but you want to make sure that they budgeted for it, and you don't want to give them a sticker shock, at age 80 where they're not going to pay the price because they think they're getting a rate increase. So communication is really the key there.
Yeah, and there are a few people who wake up every single morning and right after they brush their teeth think about how they're going to have to flexibly maintain their universal life, right? So at the end of the day, I think it's important to kind of make the group client aware of those decisions and at the end of the day, make sure education is key.
Yeah. Now, one of the things I wanted to mention about Trustmark's Life Plus Care, which is the term to 121, their newer product,
Yep.
which interestingly enough is higher priced than their Universal Life product because, like Jason mentioned, that one only goes to age 100, whereas this one goes to age 121. So there's good reasons why. But I think they've done a lot of great things with their new product, especially in the last couple of months. As we
Yep.
talk about updates, we're quoting that Trustmark Life Plus Care a lot more often. They've added a 6% acceleration, so it gives you a higher monthly amount sooner. That's very competitive to companies like the Standard, which have 6%. They've allowed for more flexibility on employer funding. That was the biggest reason why we weren't offering them more is we do a lot, as we've talked about with employer funding, and it wasn't an easy process to do it. It created some tax disadvantages for clients and how they were funding it. Now they're allowing it as a list bill where you can have a separate bill for the employer to pay that employer funding. So, a number of other things as well that they've made changes on. So that's key. Now, Trustmark is still looking for groups that are over 100 employees. So again, the small group market is not really where they want to play, but these Unum cases, right, that are looking for new solutions, they've been much more aggressive in trying to win that business. So again, carriers kind of tell us, here's our appetite, here's what we want, and it's good to see carriers opening up and really trying to expand the types of groups they work with. So I gotta give credit to them, tip our hat to them, and again, as a result, yeah, we're trying to do a lot more business, or at least give them a shot at some of those cases because they want that business.
Yeah, so the 6% acceleration's on our roadmap to add to the quick quote tool. Not in here yet, but you will see it pop up. So you can imagine a 3,000 monthly benefit next to a 3,000 monthly benefit here and make a comparison. Um, but yeah, I totally agree. On Trustmark's side, they are the ones who always seem to be running toward the opportunity that kind of arises where people need something, need a home. They were right out in front of the Washington CARES Act, were very active, very aggressive during that time, and it's good to see them with the Unum changes really going out and trying to get groups into a new home for new hires and maybe even some of the existing employees who own Unum coverage. I think they're always it's interesting. We kind of waffle back and forth, but they are really out front in opportunities like this, which is really, really good to see.
Yeah, and then on the other hand, Chubb, obviously another top carrier that we work with, has given us the opposite impression. It's funny how all the carriers have a different personality, right? And Chubb tends to be the one that's a little bit more conservative when it comes to some of those situations. They don't necessarily want the Unum cases. They want to get multiple lines of business, not just long-term care. They want to diversify, what they're offering to clients. They don't want employer funding as much as they used to, is what we're hearing. So again, not the direction we'd like them to go, of course, but it's important to pay attention to the personality of the carriers because that's going to dictate whether you get proposals, how much they're going to try to give you better offers, and how easy it is to enroll them. So don't ignore, the signs that you're seeing there. I would still RFP them, of course. I would still, see what they put in writing for you because you might be surprised at a case that they want to take. It might be based on industry or it might be based on other dynamics of the group. But don't be surprised, if you get a DTQ, right, a decline to quote back saying, hey, this is not a case that we think we're going to be competitive for. That's okay. That's
Yep.
not a decline or a turn down. It's you doing your due diligence. And more and more these days, too, we're trying to expand the number of carriers we're quoting. We're trying to show the clients we're doing more due diligence. And there's more options emerging that we won't even know about until we quote it sometimes. We'll talk
Right.
a little bit maybe about new carriers on this session, but it's important to pick some of your top carriers, but be open-minded because there may be other options out there that you should start to look at.
Yeah, and just to kind of reiterate and to bring clarity to what you said, Chubb is going to be moving in a direction where um, they're going to want to see essentially what they call bundled cases, that include their lifetime benefit term product, as opposed to what they would call standalone, just the lifetime benefit term and no other product lines. So they're attempting to, um, not so much reduce their overall exposure to lifetime benefit term, but they want to kind of increase their exposure to some of their other VB products, like their accident, their critical illness, their hospital indemnity. And this can be a very positive thing for many groups that we work with. There are, plenty of groups out there that are not covered by something like an AI or CI plan, and overall, we actually see them as really complementary to group long-term care, right? I mean, if you have, some sort of accident that results in injury, well, you may need long-term care as a result of the injury, but long-term care coverage is not going to pay you for the immediate medical expenses that accrue as a result of that accident, right? I also think for groups that don't have a super large amount of disposable income, but maybe have high incidence of young families, Chubb's accident plan is actually quite attractive to look at, especially when you consider that there's um, an organized sports package that you can purchase that gives you a 25% increase to benefit received if the accident is a result of organized sports. So I think there's a lot of really attractive things to look at Chubb's ancillary voluntary benefits for. But just know if you want access to lifetime benefit term, unless it is an exception, you will likely have to bundle a couple of products to that enrollment. So just wanted to make that a bit clearer. And, these are always fluid situations, but this is what we're hearing kind of up to the minute.
Yeah, let me also talk about some of the newer hybrid carriers first.
Hmm.
Because if you guys are getting quotes or you're hearing about it in the marketplace, definitely send us some of that intel information. We're aware, Mass Mutual is planning to launch a product this year. They have a chronic illness, but they're looking to add LTC. A little bit different story in terms of the sales. There's a dividend paying whole life, participating whole life. So, just again, different kind of approach, but again, another tool in the toolkit. We have Equitable that is in the market with something similar to Chubb's product. They want also bundled solutions, like with multiple products, like Jason was saying. Um, Voya, which has a term to 121 policy, like the ones we've talked about, is out there. Um, Lynn, you had written me a private message. Colonial, I believe, has chronic illness. I haven't seen a quote yet, so anybody that has a quote, feel free to share it. I've heard Aflac is adding long-term care to their life plan. So quite a lot of carriers out there. MetLife as well has a long-term care rider. Not doesn't have an extension rider, but an acceleration rider it has. So again, all different kinds of spins on it. Again, we've selected these four carriers that we put in the portal because they tend to have the most long-term care centric, most competitive pricing, probably the industry leaders in the sales of these products at the moment. But that's going to change, as carriers get more competitive, they're going to win more business, and carriers are going to retrench, for whatever reasons, and that's going to change. So we'll keep you up to date on the market. But like I said, there's at least 10 that I just named carriers, and some of those carriers also have multiple products, as we've seen too. They're coming out with their second generation products, or their second version of the product. Certain states as well are launching different products. We're hearing about updates from certain carriers like Transamerica. They did get their long-term care and chronic care approved in California. Now it's going to take apparently a long time to release. I think they said they're going to start quoting it mid-year, and January 2027 is when they're going to start enrolling it. But we're getting it telegraphed to us so we can start looking at some of the pricing and see where it fits, when the time comes to be able to offer it.
Yep. We're so early on into this game, and there's still a lot for carriers to learn that's going to translate into increased competition. Carriers are going to release products that actually aren't all that competitive. They're going to go back to the drawing board and they're going to either pull the product or come back with something that's more competitive, right? We can just hope that carriers put their best foot forward when releasing product, take a lot of feedback in, and use that to put good out, right? Because we're going to see carriers that were previously in the group game that have come back. We're going to see first timers that are really on their maiden voyage of group long-term care or long-term care benefit in general. Um, so there's a lot that's going to be learned. New blood pushes us forward, but also that experience really helps round us out. And at the end of the day, I think if carriers are interested in listening to feedback, there's going to be a lot of reward to come from that, and we'll see a lot of interesting change. But yeah, we're starting to see a lot of rumblings, steam coming out of the ground, like active geysers on group traditional long-term care, that is going to be entering the market this year. What do you have to share there, Mark?
Yeah, I would say we have at least four carriers entering this year with worksite traditional. And I'll distinguish it because some of them are filed as individual products, but they're um, operating in a worksite environment. So it means that we are capable of offering them the same way as we do the group products. There is at least one that is filed as a group product that's coming out. Now, a few of these carriers are going to be coming out later this year. So we're starting to get pricing. We'll be adding that to the quick quote so you guys can quote it. These four carriers. Just keep in mind that the initial date when you can enroll it may be later just because they haven't hit the market officially yet. And of course, there's going to be a state rollout for each one of them, right? Where you're going to probably get the compact states first. But some of them actually are going to get approved in like California quicker because of the trust concept. So when you file in the group side, they found the kind of a loophole with the hybrids to be able to file through a trust and get things approved quicker. Jackie's asking about underwriting on these
It's a
products.
great question.
When we say work site, in general, one of the key criteria is to have at least simplified issue underwriting, if not guaranteed issue underwriting. So it does span the gamut where several of the carriers are going to have simplified issue, but a couple of them will also have a guaranteed issue. And it looks like it's going to be contingent on employer funding, which we fully support. Obviously, it's better risk for the carriers, but they may say, hey, you need to fund at least 25 employees, and we'll give you guaranteed issue for a certain segment. Most of the individual carriers have the advantage of the ability to do buy-ups to full underwriting. On the group side, we can do buy-ups to simplified underwriting, but it might still limit, your total benefits. You may be able to buy like a full individual product to buy up from your worksite product because those individual products already exist on the fully underwritten side anyway. So I think they can be a little bit more expansive and creative with offering more benefits. So I do think those traditional products, interesting enough, will have more comprehensive benefits. But I do think they're also going to have less competitive pricing than the group hybrid market. And that's kind of the trend we've seen is that, we're starting to see the hybrids are less expensive than traditional policies. Which almost sounds contradictory, right? Because you're getting the life insurance and the guarantees on top of the LTC benefits. But again, a lot of it has to do with the comfort level of the actuaries. In the traditional market, they've had bad financial experience, right? They've had to do rate increases. On the hybrid side, they feel like there is more diversification of the benefits, like hedging of those benefits, and they're not seeing as much utilization, potentially, and maybe more lapse even on those policies. So I think a lot of those factors are making it look like the group hybrids are still going to be the lowest priced. I wouldn't wait with your groups for the traditional market. I think you still should go with the group hybrids because of pricing. But if you have a client that says, "Hey, I want tax deductibility, I want partnership, I want inflation," we have one, the standard group carrier, a hybrid carrier that's doing inflation, but most of the others do not. That might be a good signal to say, okay, let me see what we can bring in for you later this year. But when a client wants something, and they have that urgency to put into place, give them what's available. They're going to be well served. Don't just wait, to see what's out there.
Yeah, I think that's a big deal. With traditional entering the market, there's going to be a lot more to keep track of, especially like you said on the underwriting side. What we're noticing just early on when we're asking these traditional carriers about their underwriting is um, there are all sorts of different standards from what age gets what underwriting. Is there guaranteed underwriting available at all? Is it contingent on employer funding? Is it available for voluntary plans? I'd say, like Mark said, most of the time, any level of guaranteed issue coverage is probably going to focus around employer funding. Um, but even when you think about traditional long-term care with simplified issue underwriting, we also want to make sure is that an easy self-service experience for each employee, right? Does it really represent true group products from a self-service enrollment and ease of access standpoint as well? There's just a lot of little nuances to kind of be uncovered and compared, but traditional long-term care entering this market is a great thing. It will inspire innovation even from the hybrid carriers, right? Once a traditional carrier starts to get some momentum behind it and competing carriers try to understand why, that will kind of lift all competitive boats at the end of the day. Tax deductibility is something that group hybrids have the potential to do, but have not yet, broken out separately identifiable long-term care premiums, right? There's not as much of an emphasis on filing products as 7702B long-term care, right? And partnership is something you can't compete with on the hybrid side as of this moment. So I think this is a good thing that inspires competition and it works out favorably for groups and clients when carriers compete for your business, either by adding more client-centric benefits or making it more affordable and easy to access, right?
Mm-hmm.
So I'm excited personally.
Yep. And just keep in mind too, I know it sounds like a lot to take in, but that's what we do is we are your enrollment partner in these cases. We built our tools to be product agnostic. So when these new carriers come out, you'll still get that education, those calculators, everything you'll see in the buddy system, right, with the quick quote is available for your enrollment as well. And then we're working out the details with the carriers to figure out how do we do that application process in a streamlined way? How do we do the billing process? But again, that's what we do every single day here. So rest assured, we'll help you figure that out. Just figure out what's the best plan for your client, what's the best product for your client, and that's the key thing. Get that group case sold with the right conditions. That's really the key responsibility you guys have. If you have a sold case with employer funding, it's going to be a good outcome. I
I don't
can
think we actually
pretty much
annoy the
guarantee it.
carriers, but we do annoy the carriers to try to get all of the answers we can so that we can kind of bring it to you in real time and give you a flavor of what we're seeing every day. So,
Mhm. Let me.
with a lot,
I'm sorry. I saw a question in the chat. Go ahead. Sorry,
oh,
Jeff.
will they offer multi-pay with the groups? That's a good question. Um, I haven't seen much yet kind of being thrown out there and advertised, but Mark, you probably had more conversations than
Yep.
I have.
Of the four carriers, one is going to be an individual worksite product with a 10 pay, and the other is also going to have a 10 pay. So you are going to see a couple of 10 pays. The other two carriers, probably it's only going to be a recurring pay, monthly or annual pay option. So yeah, it will vary that as well amongst carriers, but we don't have 10 pays. So that's another good point, Jackie, is you're going to have a couple of worksite 10 pay options for executive groups with some types of underwriting concession potentially. Now, they may say we give you the GI, but we won't give it to you on the 10 pay. You might start to run into some of those things. Just keep that in mind.
I think, the of the traditional competitors out there, I really think, and you're probably thinking in the same vein, the carrier that makes the easiest, most fluid process is going to win out a lot of the time, in my mind, because we have to remember that if we have like a small group or an executive carve out, we can do that with individual traditional products today. So, what is the pull? What is the benefit to offer your worksite product if we can do this with individual products? That answer is going to rely on process most of the time. But of course, there could be other draws. But I just think the reason that we're not seeing that a lot with individual products, we do see it sometimes. We see it here and there, is because it's a lot of work and it's a really hefty process to have to go through individual applications for each of the employees and individual underwriting, right? So I think the traditional carrier that gets a handle on that process and truly makes it turnkey to be able to engage with is going to win out quite a bit. So
Mm-hmm.
I'm that's what I'm most excited to see. I kind of have a sense of how the product is going to work for the most part. It's a tried and true product we've known for a long time, but I'm really excited to kind of dig into the process. Or maybe I'm scared to dig into the process with some of these traditional carriers just to see how um, easy or resistant it may be.
Yeah, and just we're not trying to be coy with naming the carriers. It's just that they've asked us to keep it confidential until they announce it. What we are going to do is we're going to add them to the quick quote as soon as they allow us to, and they approve that. And I would guess that'll probably be March would be when you'll see a section of the quick quote where you can quote, traditional worksite products, and we'll display them there, assuming we get their permission. So that's where you'll first kind of hear about it from us, just to respect, their time frames, and they're still trying to figure out, their launch dates and even some of their filings and
Filings, yep.
designs. I think what they want to hear from us is feedback as to which groups are a good fit. They want to know that what they're building and what they've built are it's going to get sold in the market, right? They don't want to have like it launch and everyone be like, and then not, spend all that time. So I do think they're going to try to get our feedback early on, and we'll try to get you guys involved in that. But that's the only reason we're not naming them at the moment is just we want to make sure that they don't feel like we've jumped the gun.
Yeah, and as far as flavors of those carriers, there's some newcomers, there's some returning contenders,
Mm-hmm.
multiple ways to kind of characterize a returning contender, but there are going to be some names you recognize and some names you might not recognize. So it's going to be a nice little mix of experiences, which I think will be interesting.
Yeah, so those are four carriers that we've actually heard for sure they're launching. It's just kind of a matter of when in 2026. There's also several carriers that we're hearing about that are um, either planning a launch or planning even a kind of a new type of product. Just so you know, the rumors I've heard, nothing official yet or anything like that, but I've heard about one of the carriers building a group short-term care product. So Jackie, you might be interested in that because I know you do a lot with short-term care. We've heard about, think of like a 1 year type of work site benefit product. We've heard about an IUL, indexed universal life, right? So one that's more market-based that has an LTC rider attached to it. So, a lot of creative solutions, not traditional long-term care, not the same type of product as our hybrids, but a new type of product or a hybrid that's going to be coming into play. So I'm excited too, just to see the creativity of those actuaries and what they've designed that they've drawn from the individual market that have been best-selling products, and now they're bringing into the group market, and it's attached with LTC riders, as a primary benefit. So more to come. Lot of stuff going on.
Yeah.
all good, right? To have more options, but don't have it, kind of distract you, right? At the end of the day, it's getting the client comfortable, getting them to that finalist solution, doing your homework, but helping them say yes, helping them get to the finish line. Whatever you enroll is a good option for your client, at the end of the day. Like I'm much more even agnostic than I've ever been before because the name of the game is getting somebody coverage, period. What's the best product you can get? The one that you put into place, right? And the difference on some of these things that we talk about in the study group is minor compared to the fact of them getting something and having no coverage at all.
A
So
huge point,
keep
Mark, and I
that in
just
mind.
want to jump on top of that and just say, many of you also work in the individual space, and Mark's right, the best product is the one you're able to put in place with the client, but I think we can tend to leapfrog product and skip over what is the problem we're trying to solve here for this individual, for this group. You need to kind of get that answer from them as well. What's got you interested in speaking about long-term care? Here are some problems in the workplace or that individuals face that long-term care can be a piece of the puzzle to solve that problem, right? That education, please don't skip over it. It is the most valuable. If you don't go over that piece of education, if they don't understand the importance of long-term care, then it's not even worth sort of splitting hairs on product, and it's much harder to put a product in place. If you have somebody sitting there saying, "What am I really doing this for?" they're not going to be as engaged in the actual practice of analyzing and choosing a product. So, um, yeah, totally agree. We're throwing a lot of product news in your face right now, but there's a lot of kind of setting up the need and setting up the planning conversation as a whole, like you all are doing every day, that we have to make sure we focus on. Anything else? I think there's a lot coming. It just makes a lot of sense, right? There's a lot of interest, there's a lot of demand, there's a lot of incentive for group long-term care products to be in the market. And it's all about getting people out there covered, right? And, taking the strain off of government programs like Medicaid, right? The more people that we can sort of cover at the end of the day, the less trouble we'll be in with some of our government programs that are designed to be there for people down the road, too. There's incentive from all different directions for these products to be in the market, and we're going to continue to see them. A lot of them. Sound good? Do we wrap it? I think that's all I had.
I think we got at least most of the questions. I don't know, Lynn, you sent me a bunch of questions, but hopefully we got them answered as we went through today.
Cool. Well, really appreciate everybody being here. Thank you for your questions and your participation. And we hope you'll just kind of continue on this ride with us into the future. So, talk to you soon. Have a good one.